Hello, Samir, and welcome.
Hi. Good morning.
So let me start by asking you, liquidity was king for the markets in the past 18 to 20 months. With this drying up now, what all factors will drive the markets from here on in 2022?
So first thing, I don't think that liquidity was a very big thing for the market, simply because if you look at the FII inflows into the market, even before this fall, that means say till end of last month, the total inflows were about $6 billion only. If you look at inflows into Asian emerging market countries, which means Korea, Taiwan, India, not China, but all the others, Philippines, Malaysia, Thailand, Indonesia. I read recently that till end of November, they had outflows of $38 billion.
Okay.
Then you see inflows into our into our venture capital, private equity. That is like some 40-50 billion dollars, but that cannot be qualified under short-term liquidity because that money will be locked up for 5 years, 7 years, whatever number of years. So I don't think that India itself and even our region was a very big beneficiary, at least of equity linked easy flows.
Okay. So even if the flows were to the tune of $6 billion in 2021, even they tapering down or trickling down in 2022, why is it getting so much of a flutter in
So I
equity
don't think
markets?
it will in the end. That's what I'm saying. I don't think this will create in the end too much of a difference. If what happens is once you are lost in that moment, for that month, it might be a big number if somebody takes out $4 billion, suppose. But if you take out 4 billion over a year, nobody cares. So sometimes these things get exaggerated. I don't think that this per se market correction, if it is to be linked only to withdrawal of liquidity, is such a big deal. So I don't think this correction is just because of this. It could be because of Omicron. It could be because of somebody resetting his equity kind of thing, or a few, panic or short term or whatever you want to call it. But I don't think this is the sustainable answer to the question that because interest rates are high going up, this market had to fall this much or more.
And foreign funds now look at India as an alternate destination, given the developments in China. Or are they going to focus more on other emerging markets?
Now that depends, but for the last 5 years, India has getting money disproportionate to its weight in the emerging market index. That means somebody is actively preferring India. And that is very easy to see by looking not that India got more money, because see, India's weightage in the index around 12%. Okay. And Korea's weightage in that same emerging market index is some 16%, and China is some 33-34%. So in the last 3-4 years, Korea, Taiwan also is higher than India, some 13-14%. So 10% higher than India. So Korea and Taiwan were actually having absolute outflows, and India was having inflow, which means that India was being actively preferred. So why should that change? And now with China having 33-34% weight, if somebody even backs off 5-10% of that weight, saying that if I'm putting 100, no, I want to put 95, which means instead of 33, I want to put 31 or 32, that 1 or 2%, the natural beneficiary of that is India.
So if the markets were to go up from here over the next 6 to 12 months, where do you see the leadership emerge from?
So we broadly don't change what we normally like, which is we like financials, we like tech pharma. And in the recent years, we had made it tech pharma and specialty chemical, although we don't really these days like it too much because the prices have gone up a lot, valuation that means. And we like consumer, but the consumer that we like is mostly middle class under penetration, not India under penetration, which means we like these McDonald India or Jubilant India kind of thing, which is more catering to the urban, the 300-400 million population rather than a billion population.
So growth, value, or momentum, what should investors chase in 2022?
Well, we choose growth and value as a mix, sort of. In the sense that growth should be there, but it should not be at unprecedented high valuations. It's not that high valuations we all. So growth, either the growth should be really good, 25 plus,
Okay.
or the valuation should not be unprecedented high. It should be in range of what they were previously, and you can accept that.
So for 2022, should investors temper their market return expectations?
I would think that in theory, the returns can't be very high. So the longer term returns from the market or for the last 25 years at the NSE 500 level have been 15.8% per annum. I calculated recently. I mean, I saw recently. And therefore, in the 14-15% is the normal longer term range of returns. Now, we don't know what you'll get because in the end, you never get these kind of numbers, but the annualized number becomes 15. But the best bet would be somewhere in this range of mid-teen numbers, mid-teen returns for the index.
Okay. Thanks, Samir, for joining us today. We hope to see you soon. Have a great
Thank you.
2022.
Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.